You walk into a dealership. You find a car you like. The sticker says $35,000. You can't pay $35,000 in cash because you're a normal person, not a hedge fund manager. So you finance it. The salesperson asks one question: what monthly payment works for you? You say $450. They smile. They disappear into the back for 20 minutes. They come back and say, "Great news. We got you to $448 a month." You feel like you won. You didn't win. What just happened is one of the most effective financial illusions in consumer economics. The price of the car didn't change. The interest rate wasn't negotiated in your favor. The only thing that changed is the number of months you'll be paying. They stretched your loan from 60 months to 84 months, and suddenly a car you couldn't afford at $583 a month became a car you can afford at $448 a month. The monthly number dropped. The total cost went up by thousands of dollars, and you won't realize it until year 6, when you still owe $8,000 on a car that's worth $11,000, and your transmission just failed. Car loans aren't inherently evil. Financing is a tool, and like any tool, it can be used well or used badly. But the way the auto industry structures, presents, and sells car loans is specifically designed to make you focus on the monthly payment and ignore the total cost. And that focus, that tunnel vision on one number, is where the money disappears. Let's do the math that nobody shows you. A car loan is a simple concept wrapped in deliberately confusing packaging. You borrow money from a lender, a bank, a credit union, or a finance company to buy a car. You agree to pay that money back over a set number of months, plus interest. The car itself serves as collateral. If you stop paying, the lender repossesses the car. 3 numbers define every car loan: the principal, how much you borrow; the interest rate, the cost of borrowing, expressed as an annual percentage rate or APR, and the term, how many months you have to pay it back. The principal is straightforward. It's the amount financed after your down payment, trade-in value, and any applicable taxes and fees. If the car costs $35,000 and you put $5,000 down, you're financing $30,000 plus taxes, registration, and any dealer fees, which might push the financed amount to $32,000 or $33,000. The interest rate is where the cost of borrowing lies. A 6% APR means the lender is charging you roughly 6% of the remaining balance per year for the privilege of using their money. The higher the rate, the more you pay in total. The lower the rate, the less you pay. The term is the one that does the most damage because it's the one people manipulate to make unaffordable cars seem affordable. Common loan terms are 36 months, 3 years, 48 months, 4 years, 60 months, 5 years, 72 months, 6 years, and 84 months, 6 years, and 84 months, 7 years. Some lenders now offer 96-month terms, 8 full years of car payments. 8 years. For a machine that depreciates every single day you own it. Most people hear 6% interest and think, that's only 6%, how bad can it be? The answer is worse than you think because of how interest is calculated on an amortizing loan. Car loans use simple interest calculated on a declining balance. Each month the lender calculates interest on whatever principal balance remains. Your monthly payment is split between interest and principal, and early in the loan, the majority of your payment goes toward interest, not toward actually paying down the car. Let's run a real example. You finance $30,000 at 7% APR for 60 months. Your monthly payment is about $594. Over the full 60 months, you'll pay a total of roughly $35,640. That means you paid $5,640 in interest alone, almost 19% on top of the original loan amount. The car cost $30,000 to buy. It cost $35,640. Now watch what happens when you stretch the same loan to 72 months. Same $30,000. Same 7%. The monthly payment drops to about $512. That's $82 less per month. Feels nice, but the total paid over 72 months is roughly $36,164. You paid $6,164 in interest, $1,224 more than the 60-month loan. The monthly payment went down. The total cost went up. You paid an extra $1,224 for the privilege of taking longer to pay. Stretch it to 84 months. Monthly payment drops to about $453. Total paid, $38,053. Interest paid, $8,052. Interest paid, $8,052. You just paid $8,000 in interest on a $30,000 car. That's 27% of the purchase price added on top, just for the financing, and you're still making payments on a car that's now 7 years old and worth a fraction of what you paid. Now do it at a higher rate. Same $30,000 at 12% APR for 84 months, which is not uncommon for buyers with lower credit scores. Monthly payment, about $537. Total paid, $45,108. Interest paid, $15,108. You paid more than half the car's value again in interest alone. The $30,000 car cost you $45,000. That's not a car loan. That's a second car's worth of money vanishing into interest payments. The math is not complicated, but it's invisible when the only number on the table is the monthly payment. Nobody at the dealership is showing you the total cost. They're showing you $453 a month and asking if that works. It works in the sense that it fits your monthly budget. It doesn't work in the sense that it's costing you $8,000 in invisible money. The monthly payment is the most dangerous number in car buying. Not because it's wrong, it's a real number you'll really pay, but because it hides the total cost of the transaction behind a small, digestible figure that feels manageable. Think of it like a restaurant menu that only shows daily prices. This steak is only $1.50 a day. That sounds cheap. But $1.50 a day for a year is $547.50 for a steak. You'd never buy a $547 steak, but framed as $1.50 a day, it feels reasonable. Car loans do the same thing. They take a massive financial commitment and chop it into monthly slices that feel small enough to swallow. The monthly payment also lets dealers perform a sleight of hand that most buyers never notice. You negotiate the price of the car down by $2,000. Great. Then the dealer extends the loan by 12 months and raises the interest rate by half a point. Your monthly payment is lower than your original target, so you feel like you got a deal. But the total cost of the loan went up by more than the $2,000 you negotiated off the price. You won the battle and lost the war. The monthly payment masked the total cost. This is why every financial advisor, every consumer protection agency, and every honest person who understands car financing will tell you the same thing. Negotiate on the total price, not the monthly payment. The total out-the-door price, the interest rate, the loan term. These are the three numbers that matter. The monthly payment is just what those three numbers produce when you do the division. It's the output, not the input. Negotiate the inputs. Here's where car loans go from expensive to genuinely dangerous. Negative equity, also called being underwater or upside down, means you owe more on the loan than the car's worth. This happens because cars depreciate but loan balances decrease at a different rate. In the first few years of a long loan, the car's value drops faster than your principal balance decreases. If you finance $35,000 on an 84-month loan with a small down payment, here's what happens. After 1 year, the car might be worth $28,000, but you've only paid down about $4,500 in principal. The rest of your payments went heavily toward interest in year 1. Your loan balance is around $30,500. You owe $30,500 on a car worth $28,000. You're $2,500 underwater. After 2 years, the car might be worth $23,000. Your loan balance is about $26,000. You're $3,000 underwater. After 3 years, the car might be worth $19,000. Your balance is about $21,000, still $2,000 underwater. On a long-term loan with minimal down payment, you might not reach positive equity, where the car is worth more than you owe, until year 4 or 5 of a 7-year loan. For the majority of the loan term, Selling the car or trading it in would cost you money because you'd have to write a check to cover the gap between what the car sells for and what you still owe. This is where it becomes a trap. Life happens. Your financial situation changes. You need a different car. The car needs an expensive repair that doesn't make financial sense. You want to get out from under the payment, but you can't because selling the car doesn't generate enough to pay off the loan. You're stuck. Worse, many people in negative equity don't stop driving. They trade in the underwater car, and the dealer rolls the negative equity into the new loan. You owed $3,000 more than your old car was worth. That $3,000 gets added to the price of the new car. Now you're financing $38,000 on a $35,000 car. You start the new loan even deeper underwater. It's a cycle that compounds. Each trade-in digs the hole deeper. Each new loan starts further behind. People have been known to be $10,000 or $15,000 underwater on a car because they rolled negative equity through 2 or 3 successive trade-ins. That's not a car loan. That's a financial sinkhole with 4 wheels. The dealer's role in your financing is not neutral. They are an active, profit-seeking participant, and understanding their incentives helps you avoid their traps. When the dealer arranges financing for you through a bank or lending institution, they often have the ability to mark up the interest rate. The bank might approve you at 5.5%. The dealer presents you a rate of 7%. The difference, that 1.5% spread, is called dealer reserve, and it goes directly to the dealer as profit. On a $30,000 loan over 72 months, a 1.5% rate markup costs you roughly $1,400 in additional interest over the life of the loan. You'd never know unless you independently checked what rate you actually qualify for. The F&I office, finance and insurance, is also a profit center for add-on products that get folded into your loan. Extended warranties, gap insurance, paint protection, tire and wheel packages, maintenance plans. The F&I manager presents these one at a time and tells you how much each adds to your monthly payment. It's only $22 more per month for the extended warranty. That sounds cheap, but $22 a month over 72 months is $1,584, and the warranty the dealer is selling you for $1,584 might cost $600 from a third-party provider. The F&I office's entire strategy is to monetize the monthly payment by adding products that look small per month but cost thousands over the loan term. Every product added in F&I increases the total amount financed, which increases the interest you pay on that amount over the life of the loan. A $2,000 warranty financed at 7% for 72 months doesn't cost you $2,000. It costs you roughly $2,460 after interest. You're paying interest on the warranty. You're paying interest on the gap insurance. You're paying interest on the paint protection. Every add-on compounds because it's folded into the loan's principal. Your credit score is the single biggest determinant of what interest rate you'll receive, and the difference between a good rate and a bad rate is staggering. A buyer with excellent credit, 750 and above, might qualify for 4 to 5% APR on a new car or 5 to 7% on a used car. A buyer with poor credit, below 600, might face 12 to 20% APR or higher. At the extreme end, subprime auto loans from buy here, pay here dealers and specialty lenders can carry rates above 25%. Let's see what that spread costs in real dollars. Same $25,000 car, same 60-month term. At 5% APR, monthly payment of $472. Total paid, $28,360. Interest, $3,360. At 15% APR, monthly payment of $595. Total paid, $35,698. Interest, $10,696. At 22% APR, monthly payment of $682. Total paid, $40,918. Interest, $15,918. The person with bad credit paid $12,612 more in interest than the person with good credit. For the same car, over the same term. $12,000, That's not a minor difference. That's a used car's worth of additional money going to the lender because of a 3-digit number on a credit report. This creates a brutal cycle. People with lower incomes tend to have lower credit scores. Lower credit scores mean higher interest rates. Higher interest rates mean higher monthly payments and higher total costs. Higher costs make it harder to keep up with bills. Missed payments lower the credit score further. The next car loan is even more expensive. The cycle feeds itself. If your credit score is below 770 and you need a car, the smartest financial move is often to delay the purchase, if possible, and spend 3 to 6 months aggressively improving your credit. Pay down credit card balances, correct errors on your credit report, bring any past due accounts current, and avoid new credit inquiries. Even moving your score up by 50 to 80 points can drop your interest rate by several percentage points, which translates to thousands in savings over the loan term. 3 months of credit repair can save you $5,000 to $10,000 in interest. That math is almost too good to be real, but it is. Financing isn't inherently bad. Most people can't pay cash for a car, and a well-structured loan is a perfectly reasonable financial tool. The key is structuring it to minimize cost and avoid the traps. Rule 1. Get pre-approved before you shop. Go to your bank or credit union, apply for an auto loan, and get a written pre-approval with your interest rate before you visit a single dealership. This gives you a baseline rate that the dealer has to beat or match. It removes their ability to mark up the rate without your knowledge, and it puts you in control of the financing conversation from the start. Credit unions often offer the best auto loan rates. They're not-for-profit institutions that return value to members through lower rates and fees. If you're not a member of a credit union, many are easy to join. Some require only a $5 savings deposit. It's worth the effort. Rule 2. Keep the term as short as you can afford. The ideal loan term is 48 months or less. At 48 months, you minimize interest paid, build equity in the car faster, and free yourself from the payment sooner. If 48 months is too tight, 60 months is a reasonable compromise. Beyond 60 months, the interest costs, negative equity exposure, and total financial burdens start stacking against you in ways that are hard to recover from. If you can't afford the car at a 48 to 60-month payment, the car is too expensive. That's not a failure. It's the math telling you to choose a less expensive vehicle. Listen to it. Rule 3. Put money down. A down payment of 10 to 20% reduces the financed amount, which reduces total interest paid and gives you an equity cushion against depreciation. The more you put down, the less likely you are to end up underwater. A $5,000 down payment on a $30,000 car means you're financing $25,000 instead of $30,000. At 6% over 60 months, that $5,000 down payment saves you roughly $900 in interest. If you have a trade-in with positive equity, that equity functions as a down payment. But make sure the trade-in is valued fairly. Dealers can manipulate the trade-in value to offset discounts on the new car, as we covered in the dealership video. Rule 4. Negotiate the price and rate separately. Agree on the out-the-door price of the car before discussing financing. Once the price is locked, present your pre-approved rate and ask the dealer to beat it. Some dealers can. They have relationships with multiple lenders and might find you a lower rate. If they can't beat it, use your pre-approval. Keeping the price negotiation and the financing negotiation separate prevents the four-square shell game where the dealer juggles numbers between boxes to protect their profit. Rule 5. Say no to unnecessary add-ons. In the F&I office, every product is optional. Gap insurance is the one worth considering. And only if you're financing more than 80% of the car's value, meaning you're at risk of being underwater. But shop for gap from your insurance company or credit union, not from the dealer. It's typically half the price or less. Everything else, extended warranties, paint protection, nitrogen tire fill, VN etching, should be researched and priced independently before you agree to anything in the F&I office. Rule 6. Never skip payments. Late or missed payments damage your credit score, can trigger late fees and penalty rates, and in severe cases lead to repossession. If you're struggling with payments, contact your lender early. Many will offer temporary forbearance or modified payment plans rather than repossess the vehicle, which is expensive for them too. If you're already in a car loan with a high interest rate, maybe your credit was worse when you bought the car, or the dealer marked up your rate and you didn't know. Refinancing can save you serious money. Refinancing means replacing your current loan with a new one at a better rate, a shorter term, or both. You apply for a new auto loan from a bank or credit union. They pay off your existing loan, and you make payments on the new loan instead. The car stays the same. The lender changes. The terms improve. Here's when refinancing makes sense. Your credit score has improved significantly since you got the original loan. Interest rates in the market have dropped since you financed. You discovered that your original rate was marked up by the dealer, and you can qualify for better. You want to shorten your term to pay the car off faster. In any of these scenarios, refinancing can reduce your interest rate, lower your total interest paid, or both. Let's run an example. You financed $25,000 at 11% APR for 72 months 2 years ago. Your monthly payment is about $478. You've paid it down to about $19,000. Your credit score has improved from 620 to 710 during that time. You refinance the remaining $19,000 at 5.5% for 48 months. New monthly payment, about $442. You pay it off 2 years sooner and save roughly $3,200 in interest compared to staying on the original loan. That's $3,200 saved by filling out a loan application and making a phone call. The process typically takes a few days. Some credit unions even handle the entire thing online. There's usually a small fee, title transfer, lien recording, but it's negligible compared to the savings. The one situation where refinancing doesn't help, if you're deeply underwater. Lenders won't refinance a loan for more than the car is currently worth. If you owe $22,000 on a car worth $16,000, most lenders won't touch it. You need to be at or near positive equity for refinancing to work. Most people never think to refinance a car loan. They treat the original terms as permanent, carved in stone, unchangeable. They're not. Your loan is a contract with a lender, and you can replace that contract with a better one at any time, as long as a new lender is willing to offer better terms. Check refinancing options at least once a year, especially if your credit has improved. Most car loans allow early payoff without a prepayment penalty. Check your loan agreement to confirm some subprime lenders do include prepayment penalties, which is another reason to avoid them. But the vast majority of auto loans from banks and credit unions can be paid off early at no additional cost. Early payoff saves you money because it eliminates future interest payments. If you're 3 years into a 5-year loan and you come into some extra money, a tax refund, a bonus, a side hustle payout, putting it toward your car loan principal directly reduces the remaining balance, which reduces the interest calculated on that balance for every subsequent month. Even small extra payments add up. Adding $50 per month to a $30,000 loan at 7% over 60 months shortens the loan by about 5 months and saves roughly $600 in interest. Adding $100 per month saves about $1,100 and shortens it by 9 months. You're not just saving money, you're buying back time, months of your life where you don't have a car payment. When making extra payments, specify that the additional amount should be applied to principal, not to future payments. Some lenders will default to advancing your due date, meaning they apply the extra money to next month's payment instead of reducing the principal. That doesn't save you interest. You want the extra money eating into the balance, not just prepaying the next scheduled installment. The psychological effect of watching your loan balance drop faster than expected is surprisingly motivating. Once you see the math working in your favor, once you see the payoff date moving closer with every extra payment, the momentum builds. It turns a depressing obligation into a winnable game. Leasing is a completely different financial structure that's worth understanding even if you never lease, because understanding it helps you evaluate financing more clearly. When you finance a car, you're paying for the entire value of the vehicle plus interest, and at the end, you own the car. When you lease, You're paying for only the depreciation that occurs during the lease term, typically 2 to 3 years, plus interest, called the money factor in lease terminology. At the end of the lease, you return the car. You don't own anything. You've paid for the use of the vehicle for a set period and a set number of miles. Leasing results in lower monthly payments than financing because you're paying for less of the car's value. A $40,000 car that's worth $25,000 after 3 years has $15,000 in depreciation. On a lease, you're essentially financing that $15,000 plus fees and interest rather than the full $40,000. The monthly payment is lower, often significantly. But leasing has constraints. Millage limits, typically 10,000 to 15,000 miles per year, mean you're penalized for driving too much. Excess wear and tear charges at turn-in can add up. You can't modify the car, and at the end of the lease, you have no asset, no car, no equity, nothing. You return it and start over, likely leasing another car with another set of payments. It's a perpetual payment cycle with no finish line. Financing has a finish line. You make 48 or 60 payments and the car is yours. Every month after that is payment-free. If you keep the car for 10 years, 5 years of payments, followed by 5 years of no payments. The effective cost per month over the full ownership period is much lower than leasing 2 or 3 vehicles over the same time frame. The calculus favors financing for people who keep cars long-term, drive a lot, and want to eventually be payment-free. Leasing favors people who want a new car every few years, drive predictable and limited miles, and value having the latest features and warranty coverage above building equity. For most people trying to build wealth and minimize their transportation costs, financing a reliable car on a short term and driving it for years after it's paid off is the most cost-effective strategy. The cheapest car you'll ever drive is a paid-off car that still runs well. Just pay cash is easy advice to give and hard advice to follow. Most people don't have $20,000 to $30,000 sitting in a savings account waiting to buy a car. But the principle behind the advice is sound. The less you borrow, the less you pay. If you can pay cash, you save every dollar that would have gone to interest. On a $25,000 car at 7% for 60 months, paying cash saves you $4,380 in interest. That's real money. It's a vacation. It's 6 months of groceries. It's a significant chunk of an emergency fund. But paying cash isn't always the optimal move, even if you have the money. If your savings are in a higher return than your loan's interest rate, for example, your money is invested at 8% and the loan is at 4%, you might come out ahead by keeping your money invested in financing the car. This is called leveraging, and it makes mathematical sense in specific circumstances. However, for most people, the psychological benefit of having no car payment is worth more than the marginal financial optimization of leveraging. No payment means no monthly obligation, no risk of underwater equity, no stress when the budget gets tight, and complete freedom to sell the car at any time without worrying about a payoff balance. The peace of mind has value that doesn't show up on a spreadsheet. The practical compromise for most people is pay as much down as you comfortably can while maintaining a healthy emergency fund. Finance the rest on the shortest term you can afford, and make extra payments toward principal whenever possible to pay it off early. Here's an exercise nobody does, but everyone should. Calculate the true total cost of owning your car, not just the purchase price, but everything. Purchase price plus total interest paid on the loan, plus insurance premiums over the ownership period, plus fuel costs, plus maintenance and repairs, plus registration and taxes, minus the car's resale value when you eventually sell or trade it. For a typical $30,000 car financed at 7% for 72 months, driven for 6 years, and sold for $10,000, purchase price $30,000. Interest paid $6,864. Insurance over 6 years at $150 fuel over 6 years at $150 month, $10,800. Maintenance and repairs over 6 years, $6,000. Registration and taxes, $1,500. Minus resale value, $10,000. Total cost of ownership, approximately $55,964. You paid $55,964 to drive a $30,000 car for 6 years. That's $9,377 per year, $777.7 per month. The monthly payment of $512 was never the real monthly cost. The real monthly cost was $777 when you include everything, and that doesn't even account for the opportunity cost of the money, what you could have earned if those dollars were invested instead of depreciating in a driveway. This isn't meant to make you feel bad about owning a car. Cars are necessary for most people. But understanding the true cost changes how you make decisions. Maybe the $30,000 car should have been a $22,000 car. Maybe the 72-month loan should have been 48 months. Maybe the $150 a month insurance was reducible to $100 with a higher deductible and some shopping around. Every lever you pull reduces the total cost, and the biggest lever, the one with the most impact, is the amount you borrow and the interest you pay on it. A car loan has 3 components: principal, interest rate, and term. Interest is calculated on the declining balance, and longer terms mean dramatically more total interest paid. A $30,000 loan at 7% costs $5,640 in interest over 60 months, but $8,052 over 84 months. The monthly payment is a distraction. It hides the total cost behind a small, palatable number. Negative equity happens when you owe more than the car is worth, and long loans with small down payments make it nearly inevitable. Rolling negative equity into a new loan digs the hole deeper with every trade-in. Dealers mark up interest rates for profit and fold expensive add-ons into the loan to make them seem cheap per month. Your credit score determines your rate. The difference between good and bad credit can be $10,000 or more in interest. Get pre-approved before shopping. Keep terms to 60 months or less. Put 10 to 20% down. Negotiate price and rate separately. The true cost of owning a car is far higher than the purchase price. Factor in interest, insurance, fuel, and maintenance to understand what you're really spending. Car loans aren't designed to keep you broke, but they're structured in a way that makes it very easy to end up that way if you don't understand the math. The auto industry sells cars on monthly payments because monthly payments obscure the total cost. They offer 84-month loans because 84-month loans make expensive cars look affordable. They mark up interest rates because most buyers don't check. They roll negative equity because most buyers don't understand it. Every piece of the system is optimized to extract maximum revenue while keeping the monthly number palatable enough that you sign the paperwork. Your defense is math, actual math, total cost, not monthly cost. Interest paid, not interest rate alone. Loan balance versus car value at every point in the loan. These are the numbers that tell the truth. The monthly payment is a story. The total cost is the fact. Next time you're sitting in a dealership and someone asks what monthly payment you're looking for, smile and say, "Let's talk about the total out the door price first." Then watch the energy in the room shift, because that sentence means you understand the game, and the game only works on people who don't. If this video just saved you from an 84-month loan that would have cost you $8,000 in interest, or made you reconsider the car you're about to finance, hit like, drop your current loan term, and rate in the comments so we can collectively do the math and either celebrate or mourn, and subscribe so you stop making 5-figure decisions based on a single monthly number that was designed to make you say yes later.